Good morning, good afternoon, or good evening, depending on when you're watching this video. I'm Bailey Sonneberg representing the Tiger Ducks, along with my fellow group members Caden Plett, Kyle Reinhardt, and Will Clark. And the company that we'll be analyzing and talking about today is Campbell's Soup. For some brief history on the company, Campbell's was originally founded in 1869 with the sole purpose of canning vegetables. By the turn of the 20th century, Campbell's introduced and pioneered the production of condensed soups. The company was officially incorporated in 1922, and by the time World War II rolled around, they were assisting the United States military in supplying food rations for soldiers. Campbell's grew exponentially during that time and went public on the New York Stock Exchange in 1954. Since then, after several transfers in ownership and company acquisitions, Campbell's has expanded their product offering as they now operate in the broader packaged foods industry. Currently, the company has just south of 15,000 full-time employees, and their stock is trading for right around $52 per share. The company has two main segments that they operate through, and that is meals and beverages as well as snacks. So one of Campbell's Soup's closest competitors today is Kellogg's, and we'll be comparing each of the company's financial data over recent years to get a gauge of where they stand at the present day. First, Caden will be starting us off with a look at the company's specific financial information, starting with liquidity ratios.
Thank you, Bailey. Now on to discuss our first ratio. The first ratio we'll be discussing is the current ratio. The current ratio measures a company's ability to pay short-term obligations. Campbell's Soup has had a fluctuating average between 0.58 and 0.93 compared to Kellogg's, where they stay right around 0.7. The industry points to an average well above 1 between 1.5 and 1.8. This tells us our companies do not have the greatest ability to pay their short-term liabilities because we would want to see the number at or above 1. The next ratio we have is the quick ratio. The quick ratio measures a company's ability to convert liquid assets into cash and to pay for short-term liabilities. This ratio is similar to the current ratio, but does not account for inventory as part of assets. Both companies stay in a range between 0.25 and 0.49. The data given falls below the industry average, pointing towards a weaker ability to pay the short-term liabilities. Next, we have the debt-to-equity ratio. The debt-to-equity ratio is the product of total liabilities divided by the stockholders' equity. This ratio informs us of the organization's capital structure regarding where the company finances its operations. The higher the number, the more debt the company has compared to stockholders' equity. In 2019, Campbell's Soup boasted high amounts of debt compared to stockholders' equity, but that number decreased into amounts around 3 and 4 where Kellogg's is. The industry average tells us that on average, more organizations in the industry use more equity than debt financing. Then we will be discussing profit margin. Profit margin illustrates us how much money the company has after paying all of its expenses. For every dollar in sales, it shows us how much is left over. In 2020, we can see a big spike in Campbell's Soup profit directly correlating with the COVID-19 pandemic. This 2020 value is much above the industry average, and while it has decreased continuously up until 2022, they are still doing very well. Both companies seem to have benefited in 2022 because of the increase in profit margin, while others in the industry were hurt due to the decrease. Now on to Kyle to discuss the next ratios.
Thank you for that great analysis, Caden. Loved it. All right, so the first ratio I'm going to be looking at today is debt ratio. This ratio is found by taking total debts and dividing it by total assets. Campbell's and Kellogg's both have higher debt ratios than the industry average. Managers and lenders want this ratio to be low, but owners want this to be higher because they want to see financing through debt. Both companies have seen a decrease in their debt ratios each year. Now moving on to return on assets. This equation is net income divided by total assets. The ROA asks, for every dollar invested in assets, how much are we earning as a company? From 2019 to 2020, the ROA skyrocketed for Campbell's Soup. Their net income went from $211 million to $1.7 billion, as Caden discussed. And this was directly relating to COVID-19. Although it has dropped since then, this number was extremely promising for the Campbell's Soup Company. These findings are not a concern for both companies now, but they should stay on high alert if they continue to decrease. Now moving on to return on equity. We can find the return on equity by using net income and dividing that by common equity. This is most important for the stock owners. The ROE asks, for every dollar I invest into the company, how much am I earning? The return on equity for both companies is well above the industry average. The ROE improved tremendously in 2020 for Campbell's because of their above average year and overall company growth. Owners should be very satisfied with their return based off these findings and the performance of both companies. The ROE is on similar trends for both companies, so we are curious to see how this pans out over the next coming years. Inventory turnover is next, and we calculate inventory turnover by taking cost of goods sold and dividing that by inventory. This calculation finds how many times the inventory for the company is turned over in a year. A lower ratio could tell us that the company has weak sales or excessive inventory. We see that Campbell's Soup is consistently turning over more inventory than Kellogg's Company is, and they now have surpassed the industry average in 2020. A positive for both companies is that the inventory turnover has increased every single year. Both companies would like their inventory turnover to increase, which forecasts higher sales. I will now hand it over to Bailey, who will be discussing our last two ratios for both companies.
Thanks, Kyle. So for times interest earned, this is a capital structure ratio that's calculated by dividing your operating income by the interest expense. A higher times interest earned ratio is favorable because it means that the company presents less of a risk to investors and creditors in terms of solvency. This is an area where Campbell's excels as a company, given that they far exceed the industry average. While Kellogg's, one of their leading competitors, edges them out each year, Campbell's has closed the gap and reduced this spread over the last 4 years of company data. Moving on to look at our next ratio, we have the accounts receivable turnover. This is a liquidity ratio that's calculated by dividing the company's annual sales by their accounts receivable. Essentially, what this number is telling you is how many times in a year you're filling up your accounts receivable bucket and pouring it back out. Ideally, the higher this number is, the better, because that means that you're getting paid more often throughout the year. Looking at the data, Campbell's Soup's figures are about half the industry average, and they've decreased over the past 4 years. Their turnover rate is also significantly lower than Kellogg's in the time period that we analyzed. Now we'll be sending it over to the Sunshine State, where Will will bring us home with our final thoughts on the matter.
Thank you, Caden, Kyle, and Bailey, for the analysis of the ratios for Campbell's Soup Company. I hope that gives you a good idea of how they compete with the industry averages.